Hi friends, my name is Rahul Jain. I am a SEBI registered research analyst. Dividends are a great way to build regular passive income. I'll explain to you in the next 30 seconds to 1 minute. Let's say you buy a company stock at 100 rupees in 2026 and this company pays out 5 rupees dividend in 2026, meaning your dividend yield is what? 5%. Now come 2027, next year the same company gives 10 rupees dividend, meaning now your dividend yield has gone up from 5% to 10%. 2028, if this company again increases its dividend, let's say it gives you a dividend of 15 rupees, meaning your dividend yield has gone up to 15%. What is happening here? Your dividends are also getting added up and therefore every single year your dividends are going up, your dividend yield is getting compounded. And the growth of your dividend yield will depend on two factors. Number one is at what price you actually got the stock. And number two, can the company continuously give you higher dividend almost every single year if you look at, let's say, 5 to 10 years of time horizon? So in this video, I'm going to speak about how to find dividend stocks. I will speak about some of the key thumb rules that you need to keep in mind when you are investing in dividend stocks. And also I'll speak about some risks that a lot of people ignore when they're investing in dividend stocks. It's going to be super impactful video. Please watch it without skipping. With that, let me start with how to find dividend paying stocks, how to filter out a list. For this, I'm using a platform called TickerTape. I've been using it since 2022, right? And I use it for stock screening as well as mutual fund screening. I've given you the link in the description and pinned comment. If you want to follow along, you can do that. First thing we'll do is go to screener here, okay, and click on stocks. Right? Because we are interested in stocks, so we say start screening. Now you'll see more than 5,000 stocks coming here. The reason I'm not showing you the name of the stocks is because the data will change almost on a daily basis as the prices of the stocks move. I'm not interested in what is happening right now because I don't know when you're watching this video. I want you to understand the method so that you can apply this method anytime. And through the process, I'll teach you some practically good concepts that you might not have heard about. Okay. So first thing we'll do is we'll get rid of all of these filter parameters here. Okay. Because these are not useful for dividend stocks. So I'm going to get rid of all of them. Okay. First filter that we are going to use is market cap. Now, when a company is paying dividend, I want to make sure that the company has a certain level of market cap because very small companies might give you a lot of problems in terms of debt, cash flow, etc. So I'm going to go with minimum 20,000 crores of market cap. So I'm going to simply type it here. Okay. And I only want to filter out those companies that have minimum market cap of 20,000 crore, right? So I get around 375 companies. The next criteria that I'm going to use is dividend yield. So simply we are going to type it here, dividend yield. Okay. So if I just go and type dividend yield here, so you will see dividend yield. Now, what is dividend yield? It's very simple. In the last 12 months or financial year, how much of total dividend the company has given divided by the current price. Okay, so dividend yield changes as the price changes and as the dividend amount changes. Now, right now, I'm only interested in those companies where the dividend yield is higher than 3%. So I'll simply say more than 3%. Give me those companies. I get around 29 companies for which the dividend yield is more than 3%. Okay. Now, when people invest in dividend stocks, they think 3% dividend yield. What is the big deal about it? But what they forget is that it's not about what is the current dividend yield. We have to look at what is the future potential of dividends, right? If a company today is giving 3% dividend yield, right, at the price that you have today, if the company increases the dividend tomorrow, then your dividend yield is likely to go up. Okay. So this is the second criteria, which is dividend yield. Now the third criteria that I'm going to add is dividend yield versus subsector. Okay. Now this is a pro filter that you can see because of this asterisk mark here. It is only available for pro members, right? If you want to get pro membership of TickerTape, you can get 45% discount on the annual plans if you use my code. I've given you that as well in the description and in the pinned comments. Now, the reason I'm using this dividend yield versus subsector is that I want to only look at those companies that are giving better dividend yields as compared to the subsector. What is subsector? So sector, for example, is financials, but within financials, you might have, let's say, public banks. This becomes your subsector. So I only want to look at those companies where the dividend yield the company is offering right now is higher than the subsector. Okay. So I'm going to click on that and I'll say if the difference, so if you see dividend yield versus subsector, it is an incremental one. So for example, the first company here, it is giving 0.87% better dividend yield than its subsector. Okay. So what I'm going to do is I'm only interested here where the dividend yield versus subsector is higher than 0%. Okay. So I get around 27 companies that are giving better dividend yield versus their subsector. Now, this is what is happening currently. right? I don't want to buy any company that is giving me dividend yield as of now. I want to make sure that I pick a company that has a very good consistent history of dividend paying, right? Because that gives me a lot of confidence that the company is a dividend paying company. The history is telling me, and they're likely to pay dividend in the future as well. There's no guarantee here, and I'll come to that in a minute. But at least I am saying that, okay, the historical track record of dividend yield is very, very good. So for this, we are going to add another filter. It is called 3-year historical dividend growth rate, meaning at what CAGR basis in the last 3 years, the company's dividend payout has gone up by. Okay, so I'm just going to click on that. And here you see, for example, the first company where the 3-year historical dividend growth rate has come down. In fact, it is in negative. I don't want that company. I want to filter out that company. Therefore, I'm going to say, give me only the ones where the dividend growth has been higher, at least it's been positive. So I'm going to say anything which is more than 0% is what I want to include here. And I get only 19 companies who have consistently grown their dividend payouts. And I explained to you this in the very first example, that if today you're getting 5 rupees dividend, what are the chances that tomorrow the company may give you slightly more dividend, because you locked your price when you bought it. And therefore, if the dividend goes up, then what happens is your dividend yield goes up. This is the concept I taught you in the beginning of the video. So I'm trying to bring that practicality into this selection here. I'm looking at 3-year historical dividend growth. Mind you, it's still not guaranteed. I'll come to that in a minute, right? With that, I get to only 19 companies. Now, there are 19 companies. How do I further choose or shortlist from these companies? One of the important factor is the valuations. You cannot just go and buy any company at any valuations. You have to look at valuations. The simplest parameter I'm going to use here is the P premium versus subsector, meaning what is the P of the company or the stock right now versus the subsector. Is it trading at premium or is it trading at discount? If it is trading at discount, it is better for me from a valuation perspective. So I'm going to add that here. And likewise, since P is not enough or sufficient, I'm going to also do PB versus subsector PB. Okay, so PB premium versus subsector here. Both I want to look at only those companies as of now which are at discount. Now, this is a very simplistic way of looking at valuation. I'm sure from a valuation perspective, you could do a lot, right? You can look at individual companies and look at their DCF, etc. But at least from a broad perspective, we have looked at these two parameters. Both are pro factors here, pro parameters on ticker tape. They are very, very important in my view. It gives you sort of a pulse about that company, where it is trading versus the subsector. Okay. So now I only get 12 companies here. Out of 19 now, there are only 12 companies which are trading at a discount from a PE perspective as well as PB perspective. This is a good shortlist in my view. Okay. One another important parameter that we would like to add here is the net income. We need to make sure that the company is profitable. It is generating profit, because if a company is not generating positive profit or the profits, then how will they give dividend out, right? So therefore, the important check that we need to do is that net income here. So I'm going to add net income here. Net income should be more than 0. Okay. At least the company is not making any losses. That's the validation I'll do. And still the 12 companies that have come out here, they are making positive net income, okay, which is a good check. Now, another important factor about dividend companies is the debt. Okay, very, very important parameter. So I'm going to add 2 parameters here from a debt perspective. Okay, one is the total debt, and I'm going to add that here. And then another is the long-term debt. Now, we all know lower the debt, better it is for companies. Okay, so within these 12 companies, you can further shortlist those companies where the long-term debt is on the lower side. Because if a company has huge debt and they're paying out dividend, there is a question that why are they not using this money? Because dividend is what? It is the retained earnings, right? Why are they not using this money to pay out their debt? That question always lingers in my mind at least. Therefore, out of these 12 companies, you can look at those companies where the long-term debt is on the lower side. Now, some of these companies here, for example, if you look at banking, right now, banks will always have debt because that's their business model. So you have to ignore the debt component depending on the nature of the business. For banks, you shouldn't consider that at all in my view. But for example, if you look at oil and gas here, or if you look at gas distribution, two-wheelers, right, you will have to look at the debt. And in my view, lower the debt, better it is. In this way, at least you have done narrowing down in terms of the 10 to 12 stocks you will always get, right, in my view. And that's a very, very good shortlist to start looking at further in these companies. Now, just because a company is paying out dividend, it doesn't mean that you go and blindly invest in that in whatever prices. You still have to do the full fundamental analysis. Mainly 3 things you need to look at: P&L statement, balance sheet, and the cash flow. Cash flow is the most important part when it comes to dividend companies. For example, here I've opened one of these companies here, okay, and I'm going to go into the cash flow here. One thing that you need to make sure in cash flow you look at is the operational cash flow. So for example, here, if this company is throwing me the cash flow which is negative here, that raises a question. Because if the company operationally is not cash positive, then it is telling me that they're burning more cash. If they're burning more cash, how are they going to sustain the profits? Because either they will have to borrow more money, right? They have to raise some finances. In that case, I'll try and keep away from that. It's a simple red flag that you can see. Out of these companies, quickly go and check the cash flows. Look at the cash flow which is positive. At least the operational cash flow will be positive. Then this is a good signal. The next thing you can look at is the free cash flow. It is good to see free cash flow. If the free cash flow is also positive, then I think from a cash perspective, there are less dangers. There is less risk in the company, and I think that is a very basic check you need to do. Of course, you can do the entire P&L analysis, the balance sheet analysis. I'm not going into details of all of that fundamental analysis, but I hope you get the point that it's very important that you look at the fundamental analysis, the valuation analysis. But this short primary criteria that I have talked about, it will give you those companies that are giving dividends, have a good history of dividends, and that's how you can shortlist your companies. Now let me move to topic number 2, which is what are the 3 thumb rules of dividend stock investing. Okay, so the first thumb rule is very, very simple. Do not just invest in a dividend paying company because they have declared a dividend. A lot of people, they say, okay, so and so company has declared 15 rupees of final dividend. Stock price is, I don't know, 100 rupees, 200 rupees, 300 rupees. Let me go and buy this company because I'm going to get that 15 rupees dividend, and then I will exit the stock immediately after getting the dividend. Please understand that this is going to be a trap in my view. Why? Simply because when you look at what happens in dividend, right? So for example, here you see this chart here, okay? A company announces the dividend. Declaration date is there. That is called dividend declaration date. Everybody will know that the company is going to give you a dividend, right? Now what will happen is there is a X dividend date and there is a record date. Record date is simply that on that day you need to have that stock in your portfolio. Then only you are going to be eligible for that particular dividend, okay? And before that day, there is a X date because of course there is a T+1 cycle here. So for example, if you buy that stock on a Monday and the record date is Tuesday, you are fine. Okay. Now, what happens is that typically once the date of record is passed and the dividend is paid out, you will see the stock prices falling by the amount of the dividend that the company has paid out. It will not be exactly the same amount. So if a company has given 5 rupees discount, it doesn't mean the company's stock price will fall by 5 rupees. No, it is not exactly by the price. But what happens is typically you will see the fall in the stock prices, which is almost equal to the dividend. So even if you buy a stock just because it is going to give you dividend, it's not going to give you anything because ultimately the stock price may adjust that. Now, how much it may adjust by depends on a lot of other parameters, liquidity in the market, demand and supply of the stock, etc. But mota, if you understand, dividend gets adjusted in the price of the stock. So don't buy a stock just because you want to just quickly make some short-term money out of dividend. No. And that brings me to the thumb rule number 2. If you want to really build regular income coming from dividends, one thing that you need to keep in mind is that it is not a short-term game. You have to look at minimum 5 years. I would say minimum 5 years of putting a money into a dividend stock. Because as I said, if the dividend paying company continuously increase their dividend, it's not going to happen in 1 year. The majority of your returns are likely to be when the dividend goes up every single year. Let's say after 5 years, the dividend has gone up by 100% or 200%. But the price at which you got the stock was very low, right? Because in 5 years time, prices may go up or high. But if you're holding it for 5 years or more, then the chances of you getting better dividend yield goes up. People don't understand it. They just want to get the dividend stock for 1 quarter, 2 quarter. No, it doesn't work like that. Look at Warren Buffett's portfolio. He's been sitting on these companies for decades, not 1 year, 2 year, 5 year. I'm at least saying at least hold a company for 5 years if you want to do dividend paying stocks, right? The third thumb rule that I think you can follow is that taxation around dividends. So I'll talk about taxation in a minute, but if you want to save taxation on dividends income that you are getting, it is useful that you might invest on your parents' name, transfer the money to parents' account, and from there you put into their demat account, because if they are senior citizens, if their income is below the taxable limit, then the taxes will not be there. It is a very, very good hack that people generally use. They put the money into their parents' name. Again, whether you can do it or not, up to you. But this is something that I wanted to share. So this is all about the 3 thumb rules that you must follow in my view. Now coming to the risks of dividend paying stocks, right? It's not that you just buy a dividend stock, sit on it for 5 to 10 years and you're going to make money. No, not necessarily. The two big risks in dividend paying stocks, number one is there is no guarantee that you're going to get dividends paid out by the companies. If a company has a good track record of paying dividend, it doesn't mean that they will continue to paying dividends. How do you make sure that there are chances that the company will pay dividend? Read their dividend policy. For example, I got the dividend policy of a company here. Okay, name doesn't matter here. If you go down, you will see that here the company has a dividend distribution policy. Every company should have ideally. And they have a policy which is saying that we will pay minimum dividend of 30% of profit after tax or PAT, or 5% of net worth, whichever is higher, subject to maximum dividend permitted and many other parameters that the company follows, the criteria they follow. So here the intent is quantified. Right? So this company's chances of paying dividend stock is better because at least they have written down their policy that they're going to give minimum of 30% of PAT, right? Versus here, for example, another example, and none of these are recommendations, by the way. Here, if you read this policy, nowhere you will find what is the percentage dividend they are likely to give, right? Here it is saying that if company meets certain criteria, for example, the free cash flow, for example, the profit growth rate, for example, the capex, etc. There are a lot of parameters that the company will follow to be able to give you dividend. So make sure before investing in any dividend paying company, you read their dividend distribution policy and establish what is the confidence level that you carry that the company is likely to continue to pay the dividends. Because remember, it's not for short term only. We are looking at sort of mid to long term of dividend paying companies. So naturally, this is a risk that you're taking, that nobody is giving you confirmed or guaranteed dividends. If anybody is claiming that, please tell them that that is misleading. Okay, it doesn't happen like that. The second big risk with the stocks is the price, the stock price. Now, generally, you would see that the prices should go up in the long term, but there's no guarantee. It is entirely possible that a company that is trading at 100 rupees today, giving you 10 rupees discount, and you think that, oh, wow, 10% dividend deal is really good. It is entirely possible that 5 years down the line, the prices may drop to 50 or 40. And the dividend might also come down. That capital loss risk always remains in the stocks. Dividends come with a lot of risk that I've explained. So these two risks you have to keep in mind. Now comes the last point, which is what is the taxation on dividends? It's very, very simple. As of now, your dividends will be taxed as per your income tax slab. Okay. And that's what I said in the previous point. If your parents or in-laws are below the income tax slabs, right? And if you invest on their behalf, or if they are investing, then their dividend might become tax efficient for you. So this is one point that you need to remember. But in dividends, there is also a TDS, and there are certain rules on that. You can please go and verify that. But simply what I know is that if a company is paying out to you more than 10,000 rupees of dividend in a particular financial year, then they will deduct TDS, and the TDS rate as of now, I think, is at 10%, right? If you declare your PAN card, etc., right? If you don't declare, then it might be higher. Again, go and check the rules, the regulations, depending on when you're watching this video, because these might keep changing. But overall, dividends are taxed. And of course, you may not like it, you may like it, but this is how it is. But make it tax conducive for yourself. So this is all about dividend stocks. Go to Ticker Tape, get the 45% discount today on the annual plans using my code, because Ticker Tape is a very, very good platform that helps you screen stocks, that helps you screen mutual funds. And there are a lot of other parameters and features that you will find on Ticker Tape. Link is in the description and in the pinned comments. I'm going to see you in the next video. Until then, keep rocking.